Hey everyone, welcome back to Corporate Decoder, the place where we read corporate fillings so you don't have to. Today we're diving into Redwood Trust's latest filing. And let me tell you, after this quarter, their financials are looking a little less redwoody. Get ready to see if this giant tree is still standing tall. This quarter, we're seeing a mixed bag with Redwood Trust. While their mortgage business is booming, especially with banks, some of their investments are giving them a bit of a headache. Is it just a temporary setback, or are there deeper roots causing problems? If you find our deep dives helpful, be sure to subscribe and check out the Discord community linked in the description. Let's jump in. Alright, we're looking at their Form 10Q, which is basically a quarterly checkup. This one is for the period ended March 31st, 2025. This form tells us exactly how Redwood Trust is doing. Jump out to nearly $13 billion, up from roughly $11 billion at the end of last year. That's a pretty big increase. It means they're holding a lot more of these loans. Clock in at $14.5 billion. So they are holding a lot of debt to finance all those loans. It's a classic finance move. Borrow money, buy assets that earn more than you pay on the debt, but also up from $313 million to $450 million to $456 million. It seems like their costs are rising too. Alright, let's scroll to the income statements, their bread and butter. So brings in $33 million, and after some back and forth with expenses and taxes, their Wiz, $14.3 million compared with $28.5 million a year ago, so a pretty big drop. That means they're earning roughly half of what they used to in the past, and their earnings per share, which tells you the profit for each share you have is down to $0 and T1 compared to 0.21 times compared to 0.21. Hendkens compared to 0.21s a year ago. Now let's talk segments, because that's where things get interesting. So from residential, consumer loans has almost doubled, going from 86 million to 162 million to 16.2 million to Foveltoffenandi Avonmore. Revenue. Corvest, which deals with investor loans, sees roughly similar revenues as last year. The star of the show seems to be the Sequoia segment. Also crept up, but so it seems like the added costs are worth the effort. Overall, there's quite a bit of volatility there that caused lower income with Redwood Investments having. Alright, let's see there. In this area, we mostly see some reorganizing Troid for the presentation of our segment financial statements. We also allocated interest expense on our secured revolving financing facility from corporate other to Redwood Investments. There was no impact to the consolidated financial statements as a result of this change. All prior period amounts related to the changes in this document were conformed to this presentation. Now let's take a peek at the risks associated with all this. Can be scary, but they are mostly being used to hedge and reduce risk. Luckily, it seems like for now there are a last look to see how much cash they have, and amount to $346,475. That's a pretty penny. Okay, that's all folks. What's my take from it all? So first of all, up more expenses Q-Shoe. Shrinking that margin app, they are originating more short-term and long-term notes than before. Basically, Redwood is betting big on mortgage growth at what appears a very high rate. And there's two sides to a coin. They are going to make a lot of money, and they're going to take on a lot of risk to do so. Daft, it also doesn't seem like their operations are getting efficient as they scale up. Long story short, things could be better, but I wouldn't say that there's a fire, just a little smoke. Alright, that's our breakdown of Redwood Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.